y'all. Happy Friday. And also happy birthday, FAMU. So today, it's been a while since I've actually done a vlog for the firm. And I've had indicator of my age is showing. I've had this vlog in mind for quite a while now, and I just never ever gotten around to it. So today I have time. So what we're going to do is get started. So of course my firm also practices tax law. I'm admitted to the United States tax court. I took courses in tax law and I enjoy tax law. Plus tax law is highly connected to estate planning law, which the firm does also. So I always try to stay up to date regarding taxes, estate planning, anything that will impact my clients or the my client avatar. That is what I want to know, what I want to communicate to you all. So there's a lot of people have already done this already, which is understandable because you want to be current, you want to be up to date regarding what you communicate to your clients. So one of the big things that came out like months ago was the One Big Beautiful Bill. And I don't care what side you're on, you still have to apply the Internal Revenue Code to your personal finances and to your business finances, right? No matter what side you're on, you have to comply with the Internal Revenue Code. So as it normally occurs with every president, there are going to be changes to the Internal Revenue Code. So this video is just going to give you what the changes were that I think are going to affect most people with the Big Beautiful Bill, basically. Okay. So the first thing that I thought was important to know was there has been the Big Beautiful Bill increased the standard deduction. So for head of household, they increased the standard deduction by $1,500. So now the standard deduction, probably not for this year, which would be your 2025 taxes, for your 2026 taxes, for head of household, your standard deduction is going to be $5,900. So, and if it is not a joint tax return or like a surviving spouse tax return, the increase was only $1,000. So now the standard deduction under this updated code is going to be $4,000 in total, which it helps. Because if you're trying to make the decision between whether or not you are going to use a standard deduction or whether you are going to itemize, if your itemized deductions are going to be less than the standard deduction, it's going to be less expensive for you to just go ahead and do the standard deduction. It's a lot less paperwork, a lot less time for your income tax preparer or for your accountant, bookkeeper, or yourself, whoever does your taxes. So less time to have to itemize everything when you can just go with the standard deduction. Okay, so if you have a higher standard deduction, which means your tax preparation costs should be a little bit smaller, and you get a bigger, just standard deduction on what is considered your adjusted gross income, right? So the next thing is the child tax credit. If you got kids, the child tax credit after 2028, there's going to be a $2,000 credit that can multiply by the cost of living rounded to the lowest multiple of $100. Okay, but the maximum that you can get for each child will be $1,400. Okay, so starting in 2028, they changed the child tax credit, and now that $2,000 credit can be multiplied by the cost of living rounded to the lowest multiple of $100, and that will be the child tax credit. But the maximum that you can get for every child is $1,400. I've never had to use a child tax credit before, and most of the times when I've been doing preparing taxes, it automatically calculates it. But I'm sure this is very helpful for families with children. Okay. And then the next thing, which is important for small business owners, is the QBI, the Qualified business income has been increased to 23%. And that's good because that's definitely something that small business owners will use, and it's really beneficial on your personal income taxes. Because of course you'll have your business income taxes if you are not registered with, if your business is not registered with the IRS as a sole proprietorship. Even if you're an LLC, if you're registered, your designation is with the Internal Revenue Service, not with your state. So if you're registered with the IRS as a sole proprietorship, even if you have an LLC, you should have a separate tax return, right? So that QBI that you would have is now been increased to 23%. And then it also states that specific service trades or businesses shall not fail to be treated as a qualified trade or business solely by reason of subsection D1A. Because a lot of times some people won't be able to use QBI because they don't fit within the specific service, trade, or business that that qualifies you for the QBI. Now they're saying that if you don't fit in exactly per se, you can still maybe use the QBI. And the QBI is actually a deduction on your personal income taxes, and you use that to lower what your actual income is, to lower your tax liability. So that's always helpful for small business owners. And I know because I used it, because I was applicable for it. Anyways, so yeah, there's that. QBI was increased to 23%. And then another thing that the big beautiful bill stated was that the estate and gift tax exemption has been increased to $15 million. So that is really helpful because especially in estate planning, one thing that the beneficiaries want to know is, how much am I going to have to pay in taxes once this property is transferred down to me? And so now, like, if a lot of people are not going to go over 15 million. I mean, it's not normal, I don't think, for it to be passing down $15 million or more for your taxes. Well, in your estate. Most people, when they have an estate, they have a house, they have a couple cars, they may have a couple businesses or so, but for the most part, people are just wanting to protect their house. And so a house, normally $500,000 to $1 million. So if you're passing that house down and you are trying to avoid, paying those estate and gift taxes for your children who will be receiving that property, it's really helpful. $15 million. It's a lot. So that's a good thing. And it's really helpful for estate planners too, because now we don't have to take into consideration too much how much that estate tax, how to maneuver the estate and gift tax applicable to our client, because of that $15 million level that it has been raised to. Okay. And then the next thing they did was they reduced the amount of itemized tax deductions. So I don't know if that's a good thing or a bad thing. I always feel like the standard deduction is always going to be better than itemizing. But if you need to itemize so that you can get a greater deduction, go ahead on and do it. But now they're saying that they are doing away with a lot of some of the itemized deductions, I guess, to, get more people to do the standardized deduction. Not quite sure why, but that would seemingly see why. Not quite sure. The next one, there's no tax on tips. So if you are in the service industry and people are tipping you for your work, because I used to be a server. I was a server and I was a bartender. And what usually happened is, the bartenders or the servers would not report their tips. Not saying you're supposed to do that, but I'm just saying it happens. But the reason, and then that would lower your income because you didn't report it, because you're supposed to be getting a cash tip. You're not reporting it. But it'll also lower your income. So if you wanted to buy a house, you wanted to buy a car, you won't be able to do that because you didn't report your tips. And if you're getting paid $2.13 an hour as a server, you know, you're not gonna make enough to you're not gonna make enough to buy a lot of the homes, properties, cars, and things you want. So you do need to report your tips. So now when you report your tips, you're not taxed on those tips. You're only taxed on your hourly rate, right? So that is very, very helpful. It's kind of like getting a dividend. You pay taxes on your dividend, on your personal income taxes, but withholding taxes aren't normally taken out of dividends because it's not, you didn't earn the income, it's just given to you. It's a totally different form. Like your earned income, like your salary comes on a W-2. However, your dividends come on a 1099 DIV, and you report that on your personal income taxes as opposed to reporting it as a W-2 because it's taxed differently. So now your tips, if you're in the service industry where you will receive tips, those tips are not, they're not taxed. So you can, report as much as you want now. No tax on that. All right. And also there's no tax on overtime anymore. So I guess when people would not want to do overtime because it would place them in another tax bracket, and the different tax bracket would cause them to make less money than if they just worked their normal 40 hours a week. Now you don't have to worry about that extra tax on the overtime. They're essentially it's not free money. However, your withholding taxes aren't going to come out of it. So if you want to work overtime, then you have that money right then and right there, as opposed to having withholding taxes being taken out of your overtime. So essentially it's saying it's a deduction on your gross income, and it is excluded from your adjusted gross income. So that's really good. Yeah. But now, like, employers probably going to be more selective in whether or not they're going to be giving you overtime and paying you overtime. Because remember, you still have to work your regular 40. And then it's whatever is over your regular 40 will be considered, overtime that is not taxed. So that's that. And then the next one was if you're over 65, so retirees out there, you get an additional deduction of $4,600. And I think that's really great because when you've lived that long, you want to, keep the income that you have. And a lot of times you are on a fixed income because a lot of people, they retire and they use their pension, they use their retirement benefits, their 401k, everything that they have built up to be able to retire at 65. And so getting that additional deduction of $4,600 is going to lower your adjusted gross income. It's going to lower your tax liability, which is good because if you are living off your 401k, and it is the 401k where they take out taxes from the money that you take from your retirement, as opposed to, taxing it when it goes in, that actually helps you out a lot. Because now your tax liability is going to be much, much lower. And so it also says this is going to be an increase of $4,000 for the 2025 tax year, as long as your income is less than $75,000 single or $150,000 joint, which makes sense because if you're single, it's when all they did for joint was double it, right? So that's really good. Increase of $4,000 for the 2025 tax year. So for this tax year, you can actually use when you file your taxes starting, usually it's like around January 15th, something like that. Between January and April, when you're filing your 2025 taxes, if you're over 65, make sure you put in that extra deduction for being over 65 and getting that deduction. It's going to be really helpful. Passenger vehicle loan interest is not taxed, which is really, really good because I also sold cars. And so it can get really expensive, the tax on the car. So now you still have you still have the tax, but the interest isn't on the tax that you pay. The interest is on the actual price of the vehicle, right? So yeah, so that cuts it out a lot because car sales are different than home sales. Home sales, it's, set. I mean, I don't know if it really fluctuates. Yeah. But either way, like the interest on your vehicle purchase. So I'm pretty sure because there's a difference. There's always a difference, and I can't quite remember if it is from if one fluctuates or not. No. A house one, it does not fluctuate unless you have an adjustable rate mortgage. It's fixed, that's it. And then the more that you pay on the principal, the faster you can pay the house off, right? With a car, they set it at the beginning, and then you pay it as you are paying off the car. So they'll tell you it'll take this long to pay off the car. But now, that interest that you have is not going to be, you don't include that when you're paying the sales tax on the car. It's just the actual price that they give you when you go into that back room into the finance department. Before you go into the finance department, you get taxed on that part. Yeah. So, and you also get a deduction for that, whether or not you itemize or not. So you can still do the standard deduction and then still get another deduction for passenger vehicle loan interest. So yeah, there's that. And then there is an increase of employer child care credit. Yeah. So it says it's 40%, which would be up to $500,000, and then 50% for small businesses. And when they say small businesses, that doesn't always mean like a small business, like, the owner, operator is also the employee. Even what you wouldn't believe is a small business would actually be considered a small business. For that one, for small businesses, it is 50%, which is, I think, up to like $600,000. So that's really helpful on your business income tax. Yeah, that's really helpful. And then there's an increase in the adoption credit, and it's refundable. Because what you have to realize is that you only get a tax refund if your credits are more than your tax liability, right? But not all credits are refundable. Some credits just lower your tax liability. And once your tax liability gets to zero, you are no longer able to use that credit on those taxes anymore. You're only allowed to use the refundable credits in order for you to get a refund. So, just in case you didn't know, the increase in the adoption credit is refundable, and it's $5,000. So that will cover the cost of you adopting a child. I'm not quite sure how much it costs to adopt. I'm pretty sure I know it's very expensive because it involves an attorney, but for good reason. So that $5,000, you would actually get that back in the year that you are expending those adoption dollars. So yes, and it's refundable. So yeah, that helps. And then they also reinstated the charitable deduction with a standard deduction. So now you don't have to make the choice between itemizing in order to use your charitable deduction or doing the standard deduction. What they're saying now is you can do the standard deduction and get an additional deduction for charitable contributions. And so for a single person, it's up to $150. And then for a couple, it will be $300. So that's very good, because I know a lot of people, you give to church, you give to your favorite organization, and so now you don't have to make the decision as to whether or not, like if you're going to give or if you're going to report it, whether or not you have to choose between standard and itemized. Now you can do the standard deduction and still get the charitable deduction. Charitable contribution deduction. All right. Then health savings account, and that's really helpful. Another good thing about health savings account, if you're a woman, is they'll allow you for feminine hygiene products. That counts. And then so you get a $500 deduction for qualified sports and fitness expenses. And so the fun thing about that is it includes, like, if you want to join like a rec sports team, or if you're joined, like those kind of things is included. So the amount that you pay to be, on a sports team, sorry, the screen. um, the amount that you pay to be on a sports team for like volleyball or like pickleball or soccer, flag football, basketball, those sports, like those team sports that you pay for, that is actually you can use health savings account, and it's actually a deduction. You get a monthly limit of half of $500 deduction, and then if it's a joint return, you get $1,000, monthly limit of $1,000. And how often are you actually going to use that much? Because that usually when you are playing like a team sport or something like that, you pay one time for the whole season or for the whole little session. So yeah, but if you're getting like tennis lessons, I guess, things like that, golf lessons, things like that, you may actually be able to use that as a qualified sports and fitness exemption and be able to use the money that you're paying for those lessons or for court time, things like that, and get the deduction to reduce your tax liability. So to reduce like your income, which will reduce your tax liability. So that's another good thing. And then the last thing that I have is a health savings account contribution increase, which is really good because it cuts down on what you have to pay out of pocket that your insurance does not cover. Some people, they don't want to deal with insurance. They don't have that much to deal with insurance. They'd rather just put their money in a health savings account. A lot of times you have to have like bare minimum insurance in order to be able to be eligible for the health savings account. So now you can, if you choose to do the health savings account and do the bare bones minimum, you can put more into your health savings account to pay for when you actually have to go to the doctor. When you actually have to have certain procedures done, you just pay with your health savings account. And so if you have self-only coverage, what was $2,250 has been increased by $4,300. And so your total now that you can contribute into your health savings account is $6,550. That's a lot for a whole year, because even when you are contributing to your IRA, I think it's $7,000 a year. So you have your IRA where you can put in $7,000 a year, and then you have your health savings account where you can deposit $6,550 a year. It's very helpful. Very helpful. And then if you have family coverage, what was $4,500 was increased by $8,550. And so now you can place $13,050 in your health savings account. That can pay for braces for your kids, glasses for your kids that are always, breaking, things like that. If your child has to get their school shots, all of that can be paid from your health savings account. So yeah, so no matter what side no matter what side you are on, there are some good things in that big beautiful bill that helps you tax-wise. So we'll see how it all plays out. I guess when people start actually filing their taxes in 2026 for 2025 and then 2027 for 2026. However, I read through, this is just my notes from reading through the big beautiful bill, and this is the actual bill. I went, online to my online law library and read the statute. These are the things that stood out and I thought was applicable to people that might be watching this vlog or anything like that. So, with that being said, those are the updates for your taxes. If you ever have tax questions, issues, or you're dealing with a tax issue, feel free to reach out to my firm. You can give the firm a call at 866-823-9572. You can also email me at attorney@dominiqueyounglaw.com. And you can also go to the upper right-hand corner of the firm's website where it says book online, and the firm's website is www.dominiqueyounglaw.com. Feel free to like, share, and subscribe. And if you have any questions, leave a comment in the comment section, and I'll definitely get back to you on that. So with that being said, happy Friday, happy birthday, FAMU. Have my orange today, and I'll see you next time.